I've been investing for well over a decade now, and my investing philosophy has greatly changed since I started. I made plenty of mistakes starting out, like buying penny stocks and trying to day trade. That certainly cost me thousands of dollars over the long term. But despite this, I've been able to build out a dividend portfolio that currently pays me on average around $530 every single month, and I've even had months where it pays me as much as almost $1,200. In fact, I'm now projecting that in just 13 years, I'll be able to entirely live off dividend payments, meaning my annual dividend income can completely cover my annual expenses. But if I wouldn't have made so many mistakes early on, there's no doubt that I would have been able to live off dividends at a much faster rate. The reality is that there's no form of income more passive than dividend investing, so it's easy to see why so many people are interested in it. The problem with this is I see so many people making massive mistakes when it comes to dividend investing, just like I did starting out. So in this video, I'm going to be giving one of the most comprehensive breakdowns of dividend investing on the internet. We're going to be touching on a broad range of topics that will undoubtedly make you a much better dividend investor and hopefully even give you the ability to one day live off dividend income. If you enjoy the information in this video, be sure to check out dividendology.com for even more insights, link in the description. So with that being said, let's go ahead and dive in. So we're currently looking at my investment dashboard where I'm basically revealing my entire dividend portfolio as of right now. And if we jump over to my dividend dashboard, we can get more insights to the actual dividend metrics of my portfolio. And like I've already talked about, my average monthly dividends close to about $530 and expected yearly dividend income around $6,353. Now that is some good insights, but it doesn't paint the whole picture. What we have to understand is there's really three main types of dividend investing, and depending on which one you are, it's going to highly impact how much dividend income you're making as of right now. So what we have to understand, there's going to be high yield dividend investors, we're going to have defensive dividend investors, and then we're going to have what I currently am, and that's a dividend growth investor. So let's talk about each of these types and look at some examples. Now to start out, high yield investors, this is what you see a lot of dividend investors do, especially starting out, and this is what I did starting out as well. And there's definitely some major pros when you do it well, but it's also a type of investing that's very easy to mess up. Now, high yield dividend investing is for investors seeking to maximize their dividend income right now, and we'll show an example of this here in just a minute. Then we have defensive dividend investing. This one's not very popular, but it's really for investors seeking more capital preservation and who have very low risk tolerance. And then we have dividend growth investing. And the way I would define this is for investors looking to maximize dividend income and returns over the long term. So let's start to look at some examples. What we can do is jump over to my dividend breakdown sheet. Again, all these spreadsheets you see in this video are available on tickerdata.com. It allows you to automatically import stock financials straight into your spreadsheet. But if we come up here and plug in VZ, let's use Verizon as an example. I'll hit enter. Again, thanks to ticker data, this data will automatically load in. Now, here's what we can see about Verizon. Look at the starting dividend yield for this company. It's sitting at about 6.14%. So by most standards, that's a pretty high yielding stock. What does this mean? Well, if we invested $100 into Verizon right now, in year one, they would pay us $6.14. That's a pretty solid starting dividend yield. But here's what we can also see about Verizon. They have not been growing their dividend at a very high rate. We have to remember, most stocks are actually going to increase the amount they pay out in dividends every single year. That's something I did not understand when I was starting out as a dividend investor. So for example, in 2014, Verizon's paying about $2.14, the next year $2.22, next year $2.27, and if we jump all the way forward to now, it's about $2.69. So yes, that dividend is growing, but what we can see is when we look at the 10-year dividend CAGR, how much have they grown that dividend over the past decade? The 10-year dividend compounded annual growth rate, it's only about 1.94%. So one of the things we have to keep in mind is they've been growing their dividend at a rate below the inflation rate. That's not a good sign. It really means, technically speaking, they're not paying out more in dividends every single year due to inflation. So we are getting big immediate dividend income, but the dividend payments in the future aren't really growing. Let's compare this to a dividend growth stock. Maybe, for example, we want to look at Domino's Pizza. Let's plug this in. Again, this data will load in, and here's what we can see about Domino's Pizza stock. The starting dividend yield is much lower, just 1.41%. So for every $100 we invest in this stock, in year one, they're going to pay us only $1.41. That doesn't get too many people excited at first glance, but again, there's a lot more to dividend investing, as we'll continue to see in this video, than just the starting dividend yield. Because look at how much they've been growing that dividend over the past decade. A 10-year dividend compounded annual growth rate of above 17%. So if we look in 2014, they paid out about $1 per share in dividend, and in 2024, $6.04. So every single year, they're increasing the amount they actually pay out in dividend income. Now, why is this so important? Well, we can actually see why when we visualize this. Let's jump back over to our Verizon example. We're looking at Seeking Alpha. Jump over to the dividend yield tab here on Seeking Alpha and scroll down and look at the 10-year dividend yield on cost. What we can see is Verizon had a 10-year yield on cost of about 5.47%. Now, let's pause right there. What even is yield on cost? What does this metric mean? Well, yield on cost is a measure used by dividend investors to evaluate the income return on their original investment in a stock. So we'll come back to this in just a second, but let's look at an example to help us better understand yield on cost. And this was something I was writing about over on dividendology.com not too long ago. We're going to use Broadcom stock ticker AVGO as an example. And this is a really good example of a dividend growth stock, and it's going to help you better understand yield on cost. What we can see below is in 2013, the company was paying 19 cents per share quarterly in dividends with a share price of $35.64. So right here, we can see 19 cents per quarter in dividends. They pay out 4 dividends a year for every quarter, so the total dividend payout for the year was 76 cents. In 2013, their share price was $35.64. They paid out 76 cents for the year in dividends, so that starting dividend yield was about 2.13%, meaning if you invested $1,000 into this stock, you get paid about $21.32 in year one. Now, that does not seem exciting at all but again, this is where dividend growth comes into play. And this is the exact type of stock I used to loathe investing into. It didn't make sense in my head, but fast forward 10 years to 2023, what happened? Well, if we look down here, we can see as of 2023, the company was paying $18.40 per share in dividends. Now remember, when we originally bought this stock in this example, the stock was trading at just $35.64, but now they're paying out $18.40 per share in dividends. Our dividend yield on cost would be 51.63%. So remember, if we invested $1,000 into this stock back in 2013 when it was $35.64, 10 years later, it's now paying us over $516 every single year in dividends. Imagine that. You make a one-time $1,000 investment and it's now paying you over $516 every year, and that amount is continuing to grow. Seeing an example like this completely changed my mind about dividend growth investing. Basically, dividend growth investing isn't about the dividend you're going to make right now, it's about the dividend you're going to get paid 5, 10, 15, 20, or in some cases even 30 years from now. So let's go back and look at our Verizon versus Domino's Pizza example. After 10 years, the high-yielding stock Verizon had a dividend yield on cost of about 5.47%. But what about the low-yielder, Domino's Pizza? Let's take a look and see what happened to them. If we go ahead and scroll down and look at their dividend yield on cost over 10 years, we can see it was above 6%. So in just a 10-year time period, dividend growth investing from a stock like Domino's actually surpassed a high-yielding stock like Verizon. Now, obviously, which is better is going to depend on many things, and we're going to address that later in the video. Now, obviously, which is better is actually going to depend on quite a few factors. So let's go ahead and jump back over to the presentation. We need to talk about the dividend growth pyramid specifically to when it comes to living off dividends, because this is going to help you determine at what point you should be selecting to choose maybe higher yielding stocks or dividend growth stocks. And thanks to my friend Jake over at Dividend Growth Investing for creating this graphic. But if we go ahead and zoom in on this graphic, let's take a closer look. What we can see is up at the top, we have some examples of stocks that are dividend growth stocks, Costco, Visa, and Lowe's. These are stocks that have been growing their dividend payment at a rate of above 12% for quite some time now. And as we go lower and lower, we see stocks that are more on the higher yield spectrum that don't necessarily grow their dividends at as high of a rate, such as Realty Income, the popular real estate investment trust. So when it comes to dividend investing, yes, you have to decide what type of dividend investor are you, and based off that information, that's going to help you select where you want to be on the dividend growth pyramid. Do you want to focus more on starting dividend yield or more on dividend growth? And here's the general rule. The longer investment time horizon you have, the closer to the top of the dividend growth pyramid that you want to be. So for example, I have Visa in my personal portfolio. If we look at Visa over on my dividend breakdown sheet, what we can see is, again, this is a low yielding dividend stock, but they've been growing their dividend at a very high rate over the past decade with a 10-year dividend compounded annual growth rate of almost 17%. So that's why we see them listed over at the top of the dividend growth pyramid. And as we get lower, we start to see stocks that have higher starting dividend yields. For example, down here, we have Coca-Cola, a much higher starting dividend yield, but they also still tend to have some levels of dividend growth, maybe between 3, 4, 5, or 6%. And then down at the bottom, we have some examples of stocks that still grow their dividend in most cases by a little bit, such as Realty Income, but typically have a higher starting dividend yield, sitting between 5 or 6%. And in a lot of cases, you can actually find some dividend stocks that have sustainable yields of about 8 or 9%. And as we'll see later in the video, there are some specific funds that could even yield up to 10, 11, or 12% that may make sense for you to buy. So again, when it comes to the dividend growth pyramid, it depends on many things like what's your time horizon, what's your goals, what is your risk tolerance, and then of course we have to understand your strategy over time should change. So I might not be a dividend growth investor forever. As I get very close to living off dividends, I'll probably start to focus more on the bottom part of the dividend growth pyramid. And depending on the valuation, I may go ahead and even start adding some of these stocks, which actually I have already done. So let's finally put this concept of dividend growth to high yield to the final test. And what we can see is when we model this out, if we assume lump sum investment, we can see over the short term, high yielding stocks are going to basically pay out more in dividends, but over the long term, because dividend growth stocks rapidly increase their dividend payouts, dividend growth stocks will start to pay out more in dividend income. And this is an example where we do not reinvest dividends. If we do reinvest dividends, we can see basically the same is still true. It just takes longer for dividend growth stocks to surpass higher yielding investments. Okay, so that's obviously great information to understand and to know, but we have to better understand what to look for when we're looking at these dividend stocks. How do we know a dividend growth stock is still going to be able to grow those dividends in the future? How do we know a high yielding stock can maintain those big dividend payments? These are questions we have to ask ourselves as dividend investors, and making those mistakes can be pretty detrimental to your portfolio. So here's what we have to know. In reality, for dividend investors, there's 5 key metrics that we really need to pay attention to. These are probably the 5 most important, and obviously there's more we'll dive into later in the video, but here's what they are: free cash flow, dividend yield, payout ratio, dividend growth rate, and dividend history. Now, you might be thinking to yourself, oh, that's okay, I think I understand all 5 of those metrics. Well, if you're a beginner, don't worry, I'm going to explain it in very beginner-friendly terms. But if you already know each of these metrics, I'd encourage you not to skip this part because there's still a lot of mistakes I see people make even though they have a basic understanding of these metrics. Now, out of these 5 metrics, there's one that's more important than all of them. It's going to be free cash flow. All these 4 other metrics right here are somehow derived from free cash flow. So let's talk about free cash flow for a moment. What is it and why is it so important? And down here, I have a quote that I said one time in a video: if you want your portfolio to be a dividend growth machine, then you need your holdings to be a free cash flow growth machine. So let's talk about it. Well, in very basic terms, free cash flow is the money a company has left over after paying for all of its bills and investing back into the business, like buying new equipment or upgrading its facilities. So think of it like a paycheck. Imagine you get a paycheck every single month, and after paying your rent, groceries, and other necessary expenses, the money you have left over is your free cash flow. You could save it, invest it, or spend it however you want. And so for the company, it works pretty much the same way, as we'll see here in just a moment. Now, why do we focus on free cash flow versus what most people would call the earnings of the business? And that's a really good question, and it's important we understand this. To start off, free cash flow reflects the actual cash generation of the business. It's a much better indicator of financial health. And then this is a big one: it minimizes accounting manipulation. And that sounds scary, but it actually happens quite a bit more often than you would expect. And I have some examples listed out here that I was recently talking about over on Dividendology.com. Because earnings can be manipulated, things like the PE ratio can also be manipulated. So for example, GE in 2018, they had asset sales that inflated their earnings, which actually masked their operational struggles. High growth companies can often have inflated PE ratios. So for example, Amazon in 2023 had a PE ratio of 250, but this was actually distorted by Rivian related losses. The actual underlying business was doing quite well. And then finally, we have Boeing's. Boeing PE had an inflated PE during the 737 MAX crisis. All of these are ways that earnings can be manipulated, but guess what? Free cash flow cannot be easily manipulated. So we understand what free cash flow is and why we might focus on it over something like earnings, but what do we do with free cash flow? Why is it important? And this is one of the most important things we're going to talk about in the entire video, and that's capital allocation. Capital allocation is the single most important task of any management team. So we have to understand there's 5 different things that a company can do with their free cash flow. They can reinvest for organic growth, attempt mergers and acquisitions, pay down debt, buy back shares, and pay out dividends. So again, paying out dividends, one of the options they have for capital allocation. So let's take just a moment, and we'll talk about this more here in a second. Let's jump back over to the dividend breakdown sheet from tickerdata.com. And again, we're looking at Domino's Pizza. Here's a key metric we want to pay attention to, the free cash flow payout ratio. This is telling us how much of a company's free cash flow is being used to pay out dividends. And in the case of Domino's Pizza, in 2024, it was 41%. Now, why is this relevant? Well, again, we have to remember there's 5 different options a company has for their free cash flow. And if they're using 41% of their free cash flow to pay out dividends, what does that mean? Well, it means they have 59% of their free cash flow left over for these 4 other options. So it's kind of a give or take scenario. We have to understand company has to choose how to use its free cash flow to reward their shareholders. And typically in most cases, if you are a dividend growth investor, you want the top capital allocation priority for the stocks in your portfolio to be reinvesting for organic growth. Why is this? Well, we want to see the companies continue to grow their free cash flow at a high rate so they can continue to grow those dividend payments at a high rate. And if we jump over and look at Domino's Pizza again, we can see that's exactly what's been happening. Because the company is able to reinvest heavily back into the business, in most years, we can see the company is able to grow their free cash flow. Free cash flow in 2014 for Domino's Pizza was sitting at $122 million, and in 2024, it ended at $512 million. So because they're heavily reinvesting back into the business, free cash flow is growing. And as a result, the company can continue to grow those dividend payments as well, as we see over here. Now, in the case of higher yielding stocks, a lot of the times that free cash flow payout ratio will be quite a bit higher, meaning there's less capital left over to reinvest back into the business. But again, we'll talk about that just a little bit more later in the video. Right now, I want to talk about what the capital allocation priorities for different dividend stocks is and look at some examples. To start off, we have Johnson & Johnson. Johnson & Johnson is what's known as a dividend king stock. What does that mean? Well, it means they've been increasing their dividend payouts for 50 consecutive years, which is a very impressive accomplishment. And if we jump over to the investor's presentation for Johnson & Johnson, you can see I pulled in an image where they clearly explain their capital allocation strategy. It doesn't matter what type of investor you are, dividend investor or anything else. You need to know a company's capital allocation priorities, and ideally they should lay them out very clearly for their investors. And what we can see with Johnson & Johnson, their capital allocation priority, number 1, is organic growth for business needs. Again, like I said earlier, this should be the top priority for any dividend growth stock so they can continue to grow their free cash flow. And then after that, we can see their next top priority is going to be paying out competitive dividends, then investing for mergers and acquisitions, and then share buybacks. So this is just an example of what you might want to be looking for. So let's look at another example. What about Visa stock? And this is a really good example because, again, we can see the top priority is investing to fund growth initiatives, but then coming in at number 2, we can see they target to pay out 20 to 25% of their earnings per share in the form of dividends. So what does that mean? Well, let's jump back over to the dividend breakdown sheet and look at Visa stock. What we can see right now is their payout ratio, which is basically the payout ratio as a result of earnings, is sitting at 21.72%, very close to the free cash flow payout ratio. So what does this mean? Well, it's right in line with what they say in their capital allocation priorities. They're using about 20 to 21% of the company's earnings each year to pay out dividends. And this is a beautiful thing because they're using very little of their capital to pay out dividends. So as a result, they're heavily reinvesting back into the business, allowing them to continue to grow their free cash flow every single year. And as a result of that, they can grow their dividends every single year. Again, 10-year dividend CAGR of almost 17%. So again, if you're analyzing a stock, go over to the company's website, look at their investors relation page, find their investors presentation, and see if they lay out their capital allocation priorities. If it's a good company, this is something they should be talking about. So you can quickly see why free cash flow is so important and why capital allocation is so important. So now we have a better understanding of free cash flow, but let's take a deeper dive into these 4 dividend metrics that we've already touched on. So to do that, again, let's jump over to our dividend breakdown sheet. We've already touched on how dividend growth stocks can grow their dividends at a high rate. We've touched a little bit on the free cash flow payout ratio, which tells us how much of a company's free cash flow is being used to pay out dividends. But there's a lot more that we have to dig into. So let's go ahead and go back to our example of Domino's Pizza. Now let's make sure we understand deeply each of these 4 metrics we just looked at, which we can do again by looking here. Now we already understand dividend yield, and we've touched on these payout ratios. What percent of a company's capital is being used to pay out dividends? But just looking at these metrics right here by themselves for any given year does not give us enough information, and let me show you why. Look at the free cash flow payout ratio over time for Domino's Pizza over here. In fact, let's zoom in and take a closer look. Here's what we can see. For the majority of the past decade, that free cash flow payout ratio has been in the range of about 40% to 25%. For a dividend growth stock, I'd consider that a very healthy range. But let's talk about an imaginary scenario over the next decade. Let's say Domino's continues to grow their dividend at a very high rate, maybe even 15%, but they don't grow their free cash flow any whatsoever. What's going to happen? Well, their free cash flow payout ratio is going to continue to climb higher and higher, meaning that more and more of their free cash flow is being used to pay out dividends. And by the time they get to 100%, they can't grow their dividend payments anymore because they don't have enough free cash flow. Why is it so important to understand that? Well, some companies will continue to grow their dividend, but their free cash flow payout ratio over time is continuing to climb higher and higher. So while their dividend growth might look good on the surface level, it's not sustainable for the long term because their free cash flow payout ratio is continuing to climb higher. We can see an example of this by looking at IBM. If we look at IBM, what we can see is over the past decade, yes, they've been growing their dividend a little bit. It started to slow down. That 5-year dividend compounded annual growth rate is about 1.43%. But take a closer look at things. Yes, that dividend has been growing slightly, but free cash flow has actually been declining. So what's the result of this? Growing dividends, but free cash flow declining means the free cash flow payout ratio is growing over time. In 2014, their free cash flow payout ratio was just 32.3%. But at the end of 2024, it had climbed all the way up to 52.27%. So obviously right now those dividends are still sustainable, but it's clear they're not trending in the right direction. Unless they can find a way to start growing their free cash flow again, their dividend growth will not be sustainable in the future. And this is why it's so important to look at the free cash flow payout ratio trends over time. Because even if a stock is growing its dividend, you want to make sure that free cash flow payout ratio is not climbing higher. This is also one of the many reasons I like to just look at free cash flow that's being generated by a company in any given year versus the actual amount paid out in dividends. So for example, IBM in 2024 generated about $11.7 billion in free cash flow, while dividends paid out was about $6.15 billion. So now you should have a much better understanding of the payout ratio, why we look at the free cash flow payout ratio over time, and why we look at free cash flow being generated versus the amount paid out in dividends. But let's talk about dividend growth. Now, we already understand why dividend growth plays such a major role in the compounding effect, how it can pay us out more in dividends every single year. But there's much more we have to uncover when it comes to dividend growth and dividend history than just simply amount that a company pays out in dividends. We have to understand what dividend growth actually means. And to summarize it quite simply, dividend growth indicates a company has financial strength, and it also indicates that management has confidence in the future earnings growth potential from the company. What do I mean by this? Well, a company should not be growing their dividends if they don't have confidence that their free cash flow will continue to grow in the future. So a good management team would say, I expect our free cash flow to grow at about 10 to 12% over the next year, and so I feel confident that we can grow our dividend at that same rate as well. So as an investor, when I see a management team confident that they can grow their dividend, I should feel confident they should be able to grow their earnings. Now, obviously, you want to dig into things and make sure that proves to be true, and their history proves that as well, but that's what management should be stating by growing their dividends. Not only that, but dividends force management to focus on the highest return on investment projects. What does that mean? Well, again, this goes back to capital allocation. We have to remember, dividends are not free money. The more free cash flow a company uses to pay out dividends, the less they have for these other options. And now, particularly when it comes to reinvesting back into the business, some companies will make a major mistake and use that capital for low return on investment projects. And we'll see a case study of this a little bit later in the video with Meta. But by paying out dividends, it helps the management team focus on utilizing their capital for the highest return on investment projects. Again, we'll see an example a little bit later. Now, the reason dividend growth is so important doesn't just stop there. It's important because inflation compounds over time just like any other investment. Now, like I mentioned earlier, the long-term goal for my portfolio is to one day live off dividends. So let's just use me as an example. If we jump over to my investment dashboard, again, this is available on tickerdata.com. But what we can see is if we assume that my monthly cost of living is about $4,000, and again, that's obviously going to be higher or lower depending on many factors. But let's be really optimistic about inflation over the next 30 years and say it's only going to be about 2%, which is actually close to the historical average, but obviously it's been quite a bit higher lately. If our cost of living right now is about $4,000, after 30 years with that inflation rate, it would jump all the way up to $7,245. Now, why are we talking about this when we talk about dividend growth? Well, if we jump over to my live off dividends analysis, and again, we'll come back and look at this a little bit later in the video, but this is what I want to pay attention to right here. Let's zoom in a little bit and look at this charted out. Again, this black line is my cost of living, and we can see every single month, every single year, this number is continuing to climb higher and higher due to inflation. But because dividend growth stocks actually increase their dividend payouts at a very high rate, what we can see is dividend growth makes us surpass our cost of living. Now, the question we often get is, what if we stop reinvesting our dividends? Would we still be able to live off dividend payments forever? And the answer is actually quite simple. As long as the dividend growth rate of your portfolio is higher than the inflation rate, then you can live off dividends forever even if you're not reinvesting dividends. So in this example right here, right where my monthly dividend payments surpasses my cost of living, as long as my dividend growth rate is higher than the inflation rate, I could stop reinvesting dividends right here and live off dividends forever. Now obviously if I'm not reinvesting dividends, this isn't going to climb as high, but it's still going to continue to climb higher at a much higher rate than my cost of living. So dividend growth stocks actually fixes the inflation problem, at least when it comes to living off dividends. So obviously that's a huge benefit for dividend growth investors. But it's not the only benefit of dividend growth. Something else we have to understand is Hartford Funds did an in-depth study of dividend growth stocks, and what they've actually found is that dividend growth stocks have way outperformed since 1980. If we zoom in and take a closer look at this, it was a study from 1980 all the way to 2023. And look at dividend growth stocks right here. Look at how much they outperformed other methods, such as stocks that were paying a dividend but didn't ever grow the dividend, versus stocks that didn't pay a dividend at all, and versus stocks that actually cut and eliminated their dividends, which proved to do very, very poorly. So over a long-term time horizon, around 43 years, dividend growth stocks way outperformed. Again, this was a study done from Hartford Funds. It's a great research study. Go Google it and check it out sometime. Now, the question we have to ask ourselves is dividend growth stocks outperforming correlation or causation? In other words, are they outperforming because they're growing their dividend? And the reality is, it's not actually causation, it's correlation. The reason dividend growth stocks have been outperforming these other methods at such a high rate is because stocks that grow their dividends are the exact same stocks that grow their free cash flow at a high rate. Again, it goes back to free cash flow. So let's look at Visa once again. What we can see with Visa, like we've seen with some other dividend growth stocks already, is they grow free cash flow at a high rate. 2014 free cash flow, $6.6 billion. 2024 free cash flow, over $18.69 billion. So yes, they've been growing their dividend, but their dividend growth is a byproduct of free cash flow growth. And ironically enough, if we jump over to Seeking Alpha and look at Visa, they've way outperformed the market over the past decade, up nearly 400%. We have to remember, in the short term, yes, the market is a voting machine. The market can jump up or down any given day. Any stock can jump up and down any given day. But over the long term, a stock is only going to rise if they can continue to grow their free cash flow. And that's exactly what's happened with Visa. So we've talked a lot about dividend growth already. We understand why dividend growth can actually pay you more over the long term. We understand how dividend growth helps us with inflation and how dividend growth stocks can actually outperform over the long term. But here's a huge problem a lot of investors have, and that's the volatility of the market. Again, this is something I was talking about over on Dividendology.com not too long ago. What we're looking at charted out down here is the S&P 500 returns over the last 95 years. Now, to start off, what we notice is, yes, there's more green than red. That's a great sign. Over the long term, the S&P 500 has provided pretty solid returns. But what we can also know is there's quite a few years where the market tends to lose a large amount. For example, just a couple years ago, 2022, the market lost around 20%. In 2018, not too long ago, the market lost around 6%, and it had negative returns in 2015, I believe, as well. We can also see a major sell-off during the global financial crisis where the market lost almost 40%. Can you imagine your portfolio dropping by 40% in a single year? And then we had the dot-com bubble where we had 3 years of pretty negative returns. In fact, 3 years of returns of over negative 10% each year. That would scare a lot of people out of investing. So what are the implications of this volatility? Now, what we already know about the S&P 500 and the market is the average market return is around 8 to 9% or closer to 7% if we adjust for inflation. But the average return is not usually what happens. If we take a closer look than this, again, I was talking about this over on Dividendology.com, but we're looking at the S&P 500 returns from 1928 to 2023. What we know is the average return is between 0 to 10%, so in this box right here. But the average return is not usually what happens. In fact, the market returning negative 10% to 0% was just as common as the market returning 0% to 10%. So what's the quick takeaway? Yes, over time, the market does provide pretty solid returns, but there's a lot of volatility, multiple years where we even see negative 10 to negative 20% drawbacks. And yes, this does cause investors to be highly emotional and make some pretty poor investment decisions, but even investors who are pretty solid investors and they stay invested in the market during these turbulent times, this can still cause major problems, and let me show you why. The vast majority of investors are exposed to a massive risk, and this risk is known as sequence risk. Now, sequence risk refers to the risk that the order and timing of investment returns can negatively impact a portfolio. Basically, poor returns early in retirement can significantly reduce the longevity of a portfolio, even if long-term average returns are actually quite strong. And you can kind of see this charted out right here, but let's take a deeper look into this. In this example, we have two different investors, and they're both starting with $100,000. We have investor blue, and then we have investor green. Again, both starting with $100,000. And the average return for both of these investors is going to be 4% over a 15-year time period. But the sequence of which they get these different returns is actually going to be different. Investor green gets negative returns in the first few years of their retirement, and investor blue actually gets decent returns in the first few years of retirement, even though their average return is the same. So what's the result? Well, we can see even though the average return was the same, investor blue ended with close to $106,000, while investor green ended with only $35,000 to $36,000. Investor blue ended up with over $70,000 more, even though they both had the same average return. The reason investor green was so bad, again, it's sequence risk. Getting bad returns early in retirement can be very detrimental to your portfolio. So when we look back at the distribution of S&P 500 returns, we have to ask ourselves, what happens to us if we find ourselves in a time period where we're ready to retire, but in that given year, the market has a steep decline of maybe around 10%, maybe 20%, or maybe even 30%. This would drastically diminish our ability to retire. What would happen if we found ourselves in a year like the global financial crisis, where it dropped almost 40%? It would take years for our portfolio to recover for us to be able to retire. Or what if something even worse happened? What if something like the dot-com bubble happened and we saw negative 10, negative 15, and then around negative 25% returns in 3 consecutive years? All of a sudden, you might be looking at another decade before you can retire. And what we can see in this case, just a few years later, we had the global financial crisis. There were many people from 2000 to 2010 that simply could not retire due to the sequence risk of returns. So why am I saying all this? Is it just to scare you? Is it to make you think you can never retire? Well, I'm telling you this because there is a simple fix to this problem. The simple fix is dividend growth investing, specifically to live off dividends. So yes, in the last decade, the S&P 500 had years with returns of around negative 18, negative 6, and negative 1%. But what you'll notice, despite this, the dividend payments from the S&P 500 still grew every single year. Every single year, the dividend payments from the S&P 500 grew. Keep in mind, this isn't even a dividend growth focused ETF or fund. So let's look at a dividend growth ETF, one that I personally own in my portfolio, like SCHD, and look at what's happened to these dividend payments over the past decade. Yes, this fund has had years over the past decade where the share price has declined, such as 2022. But again, what we can see is every single year, these dividend payments are continuing to climb higher and higher, and at a pretty quick rate as well. In fact, if we jump over to the dividend scorecard, we can see over the last 10 years, this fund has grown its dividend at about 11%, and in the last 5 years, about 11.6%. So even during these market drawbacks, when we saw the market decline by about 20% in 2018, this fund was growing its dividend at a double-digit rate. So if you're someone looking to retire in 2022, a year where the market declines, and you're dependent on how large your portfolio is, all of a sudden, your retirement might not be looking as good. But if you're relying on the dividend payments, it doesn't matter at all. In fact, it's even better. Why is this? Well, now you can actually reinvest dividends if you choose to do so at lower prices, which in turn buys you more shares, in turn paying you even more in dividend income. This is why dividend growth investing is so beautiful. As long as you're buying high quality funds and high quality stocks, you don't really have to worry as much about the size of your portfolio at any given week, month, or even year. The only thing that you know is that your dividend payments that are coming in every single month or every single quarter are continuing to climb higher and higher. It's a pretty cool feeling. To put this all into even more perspective, let's talk about what dividend growth looked like during massive bear markets. And what we can see charted out right here is the average decline for the S&P 500 during a bear market was negative 33.9% right here. Negative 34% was the average decline during a bear market. And this is for the S&P 500. Keep that in mind. Again, not a dividend growth ETF. But despite this massive average decline, being negative 34%, the average dividend change for the S&P 500 during a bear market is only negative 0.5%. So during bear markets, we see massive declines, but nearly no change to the S&P 500 dividend. What a radical difference we can see between these two. And again, I have to point out, I know I've said it, but this is just for the S&P 500. Imagine how different it would be if you were buying dividend growth ETFs or dividend growth stocks that continue to grow dividends even during bear markets. This is such an important concept to understand. And to take things a step further, it's not just the dividend growth payments that look great in bear markets. Dividend growth really outperforms during bear markets. In fact, yes, we've already talked about how dividend growers tend to outperform over the long term, but look at dividend growers during bear markets. We can see the average decline during a bear market for non-dividend paying stocks. Non-dividend paying stocks, the average decline was negative 30%, while for dividend growth stocks, it was only negative 11%. But again, to put that into context, these are companies that are still growing their dividends during this time period. So we've already touched on a lot of items. I think we've hit everything right here so far. But I want to look at two unique investment opportunities when it comes to investing. We have real estate investment trusts, and then we have covered call ETFs. And people who are particularly interested in this are typically going to be people, when we look at the dividend growth pyramid, who are kind of in this section or closer to the bottom. But in some cases, we do see some real estate investment trusts that will actually grow their dividend at a decent rate every single year. So let's talk about REITs and let's talk about covered call ETFs for a moment. What do we need to know? And while we're not going to take a deep dive, there are a couple of key concepts we have to understand. Now to start off, again, these are typically higher yielding investments. Vici Properties. This is a REIT that I actually own in my personal portfolio, and what we can see is the starting dividend yield for Vici Properties is pretty decent, sitting at about 5.39%, and if we look at the dividend history for this REIT, it's actually quite good. They've continued to grow their dividend payments every single year, and if we look at those dividend growth rates, it's pretty good for a real estate investment trust. The 3-year coming in at about 7.09%, and the 5-year about 7.7%. Now, REITs are almost never going to be able to grow their earnings, or should I say funds from operation, which is typically the metric you want to focus on for REITs, but they're never going to be able to grow those funds from operations at as high of a rate as most dividend growth stocks. Why is this? Well, REITs are required by law to pay out 90% of their earnings in the form of dividends. Now, this is really important to understand because it means two things. In order for a REIT to continue to grow, they really have two options. One, they can take on new debt, or two, they can issue new shares. So for example, if we go and jump over to my stock screener, let's come up here and plug in Vici Properties. Again, thanks to ticker data, this data will load in. Now there's plenty of metrics we can break down later, but here's what I want to focus on right now. Shares outstanding. What are we looking at here? Well, this is how many shares are in the market for investors to buy. And what we can see with Vici Properties is this amount has drastically grown over the past decade. Now, for most people, this is typically a major red flag. If there's more shares outstanding, that means that the shares that you own if you're a shareholder are continuing to decrease in value. Imagine you have a box of pizza and there's 10 slices, and then somebody comes and slices them into 20 slices. The pizza's still the same size, but all of a sudden, the value of each slice is quite a bit less. It's basically the same thing with shares outstanding. But what we have to understand with REITs is this is actually quite common. Because they have to pay out 90% of their earnings in the form of dividends, in a lot of cases, REITs will choose to issue new shares so they can have more capital, in turn allowing them to acquire more properties. So whether or not this is actually a good thing for REITs depends on quite a few different things. In reality, it depends on how profitable the projects are that they're putting their capital into. But this is certainly something that I would want you to understand if you're looking at real estate investment trusts. The other thing that I'd want you to understand is there is a lot of bad real estate investment trusts out there. Now, I own a couple in my portfolio that I am a fan of, but this is VNQ, the Vanguard Real Estate Index ETF, and we can see this is an ETF that actually holds about 162 different real estate investment trusts. And if we look at how it's performed over the past decade, it's only up about 3.62%. Now, obviously, this doesn't account for the dividends it's paid out as well, but the point is, they've certainly underperformed over the past decade. Again, there's still good real estate investment trusts out there that have a growing share price, that are growing their adjusted funds from operation, and are growing their dividends every single quarter or every single year. And an example of that would be Realty Income Corporation. Now, when we look at REITs, one of the key things we have to look at are who are those tenants, because a real estate investment trust is only as good as the tenants in its portfolio and their ability to continue to pay rents to the REIT. And what we can see in the case of Realty Income is they have over 1,500 different clients. They have a 98.7% portfolio occupancy rate. That's pretty solid. If we look at another real estate investment trust, in this case, we're looking at Agree Realty. What they do very well in their investors presentation is lay out who their top tenants are. So in this example, we can see Walmart makes up about 6.2% of the annual rent that's being paid to Agree Realty. We have Tractor Supply Co., Dollar General, Best Buy. They have all their top tenants here laid out, and then we can see how much rent they're collecting from each sector. If you keep scrolling down in the investor's presentation, you can see this is a REIT that's grown its dividend at a very healthy rate over the past decade, around a 6% 10-year dividend compounded annual growth rate, so a high starting dividend yield combined with good dividend growth. And to add to this, they actually pay those dividends on a monthly basis. Now, there's obviously a lot more to break down REITs, but the last thing that I do want to point out when it comes to REIT is the payout ratio. The payout ratio can actually be quite deceiving when it comes to REITs. If we jump over to Seeking Alpha, let's go ahead and look at ADC, Agree Realty, which we were just looking at. If we look at the dividend safety metrics for this REIT, what we can see is that dividend payout ratio is showing around 169%. But again, we have to remember, this is a real estate investment trust we're talking about. And in that case, we don't want to focus on the earnings payout ratio or even the free cash flow payout ratio. We want to focus on adjusted funds from operation. That is the key metric for REITs. So let's look at the AFFO payout ratio. We can see for Agree Realty, it's sitting at 72.59%, meaning that dividend is sustainable. So obviously there's a lot more we can dig into when it comes to REITs, but that's a pretty basic overview. But now let's talk about what gets a lot of dividend investors very excited, and that's covered call ETFs. Now, if we take a quick glance at just a few covered call ETFs, it's pretty easy to see why these get dividend investors excited. Now, to start off, these ETFs typically have higher than normal starting dividend yields. JEPI, this one has a starting yield of about 7.6%. If we look at QILD, 13.72%. And then we have probably my favorite covered call ETF, SPYI, the NEOS S&P 500 High Income ETF, with around a 13% trailing 12 months dividend yield. Now, what we have to understand about these covered call ETFs, though, are there are certainly pros and cons. We need to understand things like tax consequences as well. Now, I've actually been doing a lot of research into covered call ETFs lately, and I made a massive spreadsheet with details on over 60 plus covered call ETFs, and it goes over some of the most important things we need to know about all these different funds. It has links to the different funds' websites, has the sector they're operating in, the name, the trailing 12 months dividend yield. We have market cap, the expense ratio, when they pay out dividends, because while most pay them out on a monthly basis, some will actually pay them out weekly. We have their option strategy, which is either going to be active or passive. We have options moneyness and then portfolio options coverage. And if you don't understand these two things, don't worry, I'll explain it here in just a moment. Before we do that, let's get a very basic understanding of covered call ETFs. Again, I discussed this over on dividendology.com, but here's basically how it works. The ETF holds a portfolio of stocks. It sells call options on those stocks, which allows the ETF to earn a premium. So the income generated from premiums is distributed as income to investors, and this strategy allows covered call ETFs to pay out big dividends typically on a monthly basis. Now, before we dig into these covered call ETFs, there's probably 4 things we need to know just from the get-go. Now, to start off, monthly payouts can fluctuate by quite a bit, and here we're looking at the monthly dividends from JEPI, a pretty popular covered call ETF, one that we mentioned just a moment ago that currently has a starting yield of about 7.6%. If we jump over to the dividend tab here on Seeking Alpha to look at the dividend history for JEPI, what we can see is these dividend payouts fluctuate quite a bit on a monthly basis. In the last few years, we can see we had one monthly dividend as low as 26 cents, but we also had one monthly dividend payout that was as high as about 62 cents. So the dividend more than doubled. This is something we certainly have to make note of. If we keep scrolling down, one of the things we have to understand is volatility impacts their performance. And to put it quite simply, if we go back and look at JEPI, the more volatile the market is, the more options premium they generate, which means the bigger monthly dividend they can pay out. So volatility in the market matters quite a bit when it comes to these covered call ETFs. Point number 3 is we have to understand they have capped upside potential. Selling call options caps the upside potential of the underlying stocks, as gains are limited to the strike price of the option. We'll touch on this more in just a moment, but lastly, we have to understand there is downside protection. Premiums collected from call options can partially offset losses if the underlying stock prices decline. So we have a basic understanding, but let's make sure we understand these 2 very important concepts: options moneyness and portfolio options coverage. To start off, let's talk about options moneyness. Now, you might not have heard of options moneyness before, but this is actually one of the most important things you have to understand before you consider buying a covered call ETF. And generally speaking, there's going to be three options. And on this spreadsheet, again, I'll have the spreadsheet down in the description for free, but we can see it lists out three different common options moneyness. Let's go over each of them. We can see we have at the money calls, in the money calls, and out of the money calls. And we're going to put this in very basic terms. What we can see is at the money calls is going to be good in sideways or even slightly bearish markets. It has higher premiums, meaning more dividend income, but it basically caps all of the upside potential of the ETF. If we look at in the money calls, what we can see is they have the highest premiums, but it sacrifices the upside completely. So this is more defensive and better in bear markets. And then we have out of the money call options. This means lower premiums, but it also allows some upside potential, meaning it has more potential in bullish markets. This one tends to be my favorite. I don't want to buy any ETF that's probably going to depreciate in value over time. So again, I have the option moneyness listed out for over 60 plus ETFs on this free spreadsheet, link in the description. But then if we look at portfolio options coverage, this is really important to understand as well. A lot of covered call ETFs will write options on 100% of their portfolio. What does this mean? Well, basically it means it has these three advantages: high yields, lower volatility, and consistent income, but it also has some trade-offs: capped upside, dividend volatility, higher fees, and tax implications. But what you'll actually see looking at this spreadsheet is some ETFs don't write call options on all of their portfolio. Some will only do it on around 75 to 90% of their portfolio. Now, why is this important? Well, it means there's more upside potential. The ETF should continue to rise if the market continues to rise. That actually sounds a little bit more attractive in my opinion. And an example of an ETF that does this is going to be the NEOS S&P 500 High Income ETF, again, one that I mentioned was one of my favorites. Now we can see it's actually taken at the time of this video a little bit of a decline in the past month because the market has sold off pretty heavily. But before that, we can actually see this ETF was appreciating in value. So now we've really touched on about three different ETFs. Again, we talked about JEPI just a little bit, the JP Morgan Equity Premium Income ETF. We talked about QYLD just a little bit, and then we talked about NEOS. But again, I want you to understand the tax consequences for covered call ETFs can vary on a case-by-case basis. And let me show you an example of this. If we're talking about JEPI, without getting too into the weeds, assuming you're generating roughly $50K per year in income from JEPI, you'd owe around $8,500 of that to the IRS. Now let's compare this to SPYI. If we scroll down, one of the things we can see when it comes to tax efficiency, assuming these variables here, if we generate $50K of income per year from SPYI, you could expect to pay roughly $340 in ordinary income tax and $450 in long-term capital gains tax. This means you'd save a potential $7,710 in taxes compared to JEPI. So these are the things we have to understand. I have a more in-depth video going over covered call ETFs if they interest you. So now we have some insights on REITs and covered call ETFs, but we need to touch on something that no matter what type of investor you are, that you need to understand, and that's competitive advantages. Now, if you look online, you're going to learn about all these different types of competitive advantages. You're going to see examples with different companies. But what's important to realize is a lot of the times, competitive advantages can be revealed simply by looking at the fundamentals of a company. And let me show you what I mean. If we jump over to Seeking Alpha, let's look at an example. We're currently looking at Altria Group, stock ticker MO. This is a big dividend payer. And if we jump over to my stock screener, let's just take a glance at them and see what we see. Plug in MO and hit enter. Again, thanks to ticker data, the data will load in, and there's a lot we can break down here. But there's two key metrics we can typically turn to see if a company has a competitive advantage, and one of them is listed here. Look at these 6 metrics. Can you guess which one it is? Obviously, they're all immensely important, but return on invested capital can oftentimes point out a competitive advantage. Let's zoom in and take a closer look. Now, what is return on invested capital? Well, to put it in plain English, it's actually quite simple. It's telling us how profitable are the projects the company is investing their capital into. So remember, it always goes back to free cash flow. A company can use free cash flow to reinvest back into their business, and this tells us how profitable are those projects they're reinvesting into. So as a baseline, you probably want to see at least 10% return on invested capital, but higher quality companies a lot of the times can get up to 20%. But look at Altria Group. Look at how high it's been. It's been consistently high since 2020. It's been around 20% in 2020 and 2021, and as of the most recent year, it was 33.2%. So the projects they're reinvesting into are getting high returns on invested capital. So yes, this is a sign of a competitive advantage, but there's another one. If we jump over to our profitability/income statement sheet, let's go ahead and zoom out just a little bit and again come up here and plug in MO. Here's what we can see. There's again one key metric here that points out a competitive advantage. Let's go ahead and zoom in and come down here. Look at this gross profit ratio over the past decade. What do you notice? This is going up higher and higher nearly every single year. It went all the way from about 56.6% in 2014 to in 2024, 70.13%. That's a massive increase in the gross profit ratio. Now remember, the gross profit ratio measures how much profit a company makes after deducting the cost of goods sold. So what does it mean if we see an increase in gross profit ratio? Well, more than likely, in a lot of cases, it means the company's going to have incredible pricing power. And that's exactly what Altria has. They've been able to continue to increase the price of their products year over year, leading to increases in the gross profit ratio. So yes, we could honestly spend a whole year talking about competitive advantages and things to look for, but a lot of the times, those two key metrics are going to reveal if a company has a competitive advantage. Again, gross profit ratio and return on invested capital. Those can tell you a whole lot about a company. Now, as we move forward, we're going to touch on a very important topic, and some would consider it controversial, but it's actually true if you take a close look. But the best companies in the world pay dividends. Now, that's a strong statement, and the best way to explain it is simply by looking at a case study. So we're going to be looking at Meta stock. Now, for the vast majority of Meta's history, the stock is not paid a dividend, but that changed in 2024 when the company announced they were going to start paying dividends. And this news caused a lot of ruckus. It made people make some assumptions about Meta that in reality are actually not true, and we'll be discussing that here in a second. Now, here's what we have to understand about Meta before we even dig into things. If we jump over to my stock screener, let's plug in Meta here. And what we can see is over the past decade, revenue per share, earnings per share, and free cash flow per share have all grown at a very high rate. Keep that in mind. If we jump over to our profitability sheet, come up here and plug in Meta. What we can see is, look at the 10-year revenue CAGR, close to 30%. The 10-year net income CAGR, close to 36%. Basically, what we're trying to say is top and bottom lines for this company have been exploding over the past decade. And in fact, if we go ahead and jump over to the balance sheet for the company, we can see the company has very little debt compared to their total assets. Total debt is $49 billion, while total assets is over $276 billion. So what does this all mean? Well, basically, Meta is absolutely drowning in cash. They have so much cash, they barely know what to do with it. So again, this goes back to the discussion of free cash flow and capital allocation. When a company has that much cash, they have to use it in one of 5 ways. And for most growth stocks, obviously, they're heavily reinvesting back into the business. But for the highest quality companies in the world, think of stocks like Meta, Microsoft, and Apple. These are companies that are generating so much cash, at a certain point, they can no longer intelligently reinvest it back into the business and still get good returns on those investments. Just around a year ago, it was announced that Meta had burned through $45 billion in cash to help create Reality Labs. Now, the huge problem with this is Reality Labs had zero return on investment, basically meaning the company had just burned $45 billion. So that's $45 billion that was reinvested back into the business that again had zero return on investment. It had negative returns. That obviously turned out to not be a good use of capital. But what if they would have used that capital to actually pay out dividends? Well, it would have actually increased Meta's total return. And this is where a lot of people start to misunderstand dividend growth investing. When you buy dividend growth stocks, especially dividend growth stocks that are near the top of the dividend growth pyramid, in the right scenarios, you're getting paid dividends without sacrificing growth. That's because these top companies have already reinvested all the capital back into the business that they can intelligently invest into the business. So any capital after that should be used to do things like maybe buy back shares, pay out dividends, or pay down debt. For example, Microsoft has now been paying out dividends since 2003, and in 2013, they paid out $7.5 billion in dividends while generating about $24.5 billion in free cash flow. And if you look at them a decade later, their free cash flow nearly tripled to $60 billion, and their dividend payments grew to $18 billion annually. And of course, obviously, if we look at Microsoft over on Seeking Alpha, what we're going to see is during that time period, they way outperformed the market up over 783%. So again, in the right scenarios, the best businesses in the world pay dividends because it can actually increase their total return. Now, the huge question we often get when it comes to this is, what about share buybacks? Share buybacks have the potential to be a very effective way to reward shareholders, and let me show you what I mean. If we jump back over to our stock screener, let's take a look at Apple, who buys back a lot of stock each year. And we can see this charted out. Look, in 2014, there was about 24.3 billion shares outstanding for Apple, and as of 2024, about 15.3 billion. That's a lot of share buybacks. And look at the impact this has on all of the per share metrics like earnings per share and revenue per share. Let's put this into perspective. If we take a closer look at Apple, we'll plug it in up here. If we come over here to the top right and take a closer look at revenue versus cost of revenue, we can see in 2022, revenue was about 394 billion. The next year it was lower at 383 billion. And the next year it was still lower than it was in 2022 at 391 billion. Again, that's revenue. But look at what actually happened to revenue on a per share basis. Take a close look. In 2022, it was $24.32. The next year, it actually increased to $24.34. And in 2024, it increased again at $25.48. So why is revenue per share increasing when organic revenue, organic top lines actually decreased? Well, again, it's because the company is buying back their own stock. The amount of shares outstanding is continuing to decrease. Again, this can be a good way to reward shareholders, and you can see how it can boost other per share metrics. But share buybacks actually have the potential to be quite detrimental to a shareholder when it's not done properly. And there's a few different instances where this can be the case, and instances where dividends can actually be much better than share buybacks. Now, to start off, specifically when we're talking about living off dividends, we can see dividends are much more predictable and reliable than buybacks. And this is a screenshot I took from ADM's investor presentation, where they show the amount they're paying out in dividends versus their share buybacks. What we can see is the dividends are very predictable, they're very reliable, and they're growing on an annual basis. But if we look at share repurchases, it can vary a lot year over year. It can be a lot more than dividends some year, and in some years, it can be virtually nothing. Obviously, if you're someone looking to live off dividends, you can't let that be the case for your dividend income. But share buybacks don't just stop there. Buybacks actually have the potential to destroy shareholder value when it's done at an overvaluation. So for example, if the intrinsic value of a stock like Microsoft was only $300 per share, and a company is using most of their capital to buy back stock when it's trading at $388, that would not be good for you as a shareholder. They would be using way too much capital to buy their own stock at an overvaluation. Ideally, you want share buybacks to be done at an undervaluation. That's a really good way to reward shareholders. But the last thing we have to understand about share buybacks is, in worst case scenarios, buybacks can occasionally misalign management incentives. If a management team has an incentive to hit a earnings per share metric that would then give them a bonus, they're going to buy back their own stock for the reason we just talked about. Buying back shares can help boost per share metrics like earnings per share, which at times can give management teams short-term incentives to simply buy back stock, even if it's not the best capital allocation priority. Obviously, we want management and shareholders to be properly aligned. Now, there's just a few more things that we want to talk about. We want to talk about diversification for just a moment, some basic valuation, and then we want to talk about tax myths. Now, we're pretty familiar with diversification. In fact, let's just go ahead and jump over to my personal dividend portfolio and look at the investment dashboard. Let's go ahead and zoom out just a little bit. Now, what we can see up here is we have my allocation. These are all the stocks in my personal portfolio, and we can see it's fairly well diversified with around 29 total holdings, and this one really large holding is actually an ETF that has around 100 holdings within it, so don't let that distract you. It's actually pretty well diversified. And this is something you probably already know. Diversification reduces your risk. Something else you probably already know is you don't want to just diversify your holdings, you want to make sure they're diversified by the sector they're in as well. You don't want to be exposed to any one sector too much. But when it comes to dividend income, there's still more we have to understand. We don't want to just diversify by each individual holding, by each sector. We want to actually diversify where our dividend income is coming from. And this is a really important concept. And here's the example that I typically give. Imagine you're a dividend investor who has about 10% of their portfolio allocated to REITs, real estate investment trust, but 40% of your dividend income comes from those real estate investment trusts. While on the surface level, it doesn't look like you have too much capital allocated to REITs, but 40% of your dividend income coming from one sector would be pretty risky. So again, if we jump over to my dividend dashboard and look at my dividend income by industry, we can see real estate makes up about 12.8% of my dividend income, but if we jump back over to my investment dashboard and zoom back in over here, we can see real estate's only about 7.3% of my total portfolio. So it's important to know the difference. Now let's take a little bit of time to talk about valuation. And out of all the subjects we've been discussing in this video, this one's probably the most interesting, probably the most fun, also probably the most difficult, and we could literally spend a lifetime studying this. And I mean, that's literally what some people do. Now, we need to have an at least basic understanding of valuation if we're interested in buying individual stocks. Because even if you buy the best business in the world, you could pay too much for it. And this is something Warren Buffett has talked about before. For the investor, a too high purchase price for the stock of an excellent company can undo the effects of a subsequent decade of favorable business developments. Now, there's so many different forms of valuation, so many valuation models, and this is something I've been working with for a long time. In fact, I built out quite a few different valuation models, and they're all available and fairly automated over on tickerdata.com, but I want to focus on just 3 in this video. Just 3 or 4 somewhat simple valuation models to help you get a better understanding of how a stock is being valued, specifically dividend stocks. So we're going to be looking at dividend yield theory, Bogle's valuation, and then the dividend discount model. So let's go ahead and get started. Now, the first one we're going to talk about is dividend yield theory, and this is actually pretty straightforward. And the core idea is that a stock's dividend yield tends to revert to its historical average over time. So in this example that we're looking at right here, we can see the average dividend yield is about 3%. So when the dividend yield is under 3%, the stock would be overvalued. When the dividend yield is above 3%, it would be undervalued. So again, it's a very straightforward, simple valuation model, and Seeking Alpha actually makes it pretty straightforward. So for example, we're currently looking at Microsoft. If we jump over to the dividend tab, click on dividend yield, what we can see is right now their dividend yield for the trailing 12 months is sitting at 0.83, while their 5-year average is 0.85. So based on dividend yield theory, it looks like Microsoft is pretty much exactly at its fair value. It's very close. Now, for me personally, I don't typically use this valuation model very often, and the reason is it certainly has some flaws. For example, if we use Broadcom, stock ticker AVGO as an example, for a long time over the past decade, that starting dividend yield was between maybe around 2, 3, at some points even above 3%. That was close to the average. But lately, it's quite a bit lower. It's closer to 1%. If we jump over to Seeking Alpha and look at Broadcom AVGO, what we can see is that starting dividend yield, sitting just at 1.23%. But what we have to understand is the future growth potential of the company's earnings has gone up dramatically in just the last few years. Because of that, people are willing to pay more for the stock, which will push the dividend yield down. So in this case, it doesn't necessarily mean the stock is overvalued. They have more future earnings potential, therefore the stock price should go up, which would push the dividend yield down. So dividend yield theory is great if you are a beginner, but it does have some problems. But to be fair, every single valuation model actually has some problems. Now, the next one we're going to talk about is Bogle's valuation. So let's just go ahead and jump over to the ticker data Bogle valuation spreadsheet, and let's use an example. Maybe we want to use, again, we'll say Domino's Pizza as an example. I come up here and plug in DPZ. Now, what we'll see with Bogle's valuation is what we're doing is we're calculating the future expected return of a stock. We're going to take the earnings growth, the shareholder yield, and then we're going to add or subtract multiple expansion. Now, you might not understand what all that means, but it's actually pretty simple. Now, to start off, we have to remember, what drives share price appreciation over the long term? Well, it's quite simple. It's growing their earnings per share. It's growing their free cash flow. Over the long term, the stock price will grow roughly by the amount the earnings grow over time. So when we talk about Bogle's valuation, we want to typically use it on a 5 to 10 year time period. So when we talk about Bogle's valuation, we want to typically look at it on a 5 to 10 year time horizon. And when we talk about earnings growth, it can actually be quite simple. Yes, you should research the stock. Yes, you should research what analysts are saying and come to your own decision. But if you want to make things really simple, what you can do is just look at projections over on Seeking Alpha. You can see earnings estimates. Looks like we're looking at Broadcom. Let's go ahead and switch it to Domino's Pizza. We're looking at earnings estimates for Domino's Pizza over the next few years, and we can see it fluctuates a little bit, but something else you should be doing is going over to the investor's presentation. A lot of the times, management will state how fast they project they're going to grow earnings over the next few years, and that's exactly what Domino's has done. And off the top of my head, I believe management has stated they expect to grow earnings at a range of about 5 to 8% over the next few years. That's a rough estimate. So maybe let's go with a midpoint, and we'll go with about 6% earnings growth over the next decade. Let's go ahead and make this 6%. Now we need to apply the shareholder yield and talk about what multiple expansion is. Shareholder yield is actually pretty straightforward. It's simply going to be your dividend yield plus your buyback yield. And so you can see with the ticker data function, we're able to automatically import the dividend yield, but a company doesn't just state the buyback yield because it actually fluctuates quite a bit. Buyback yield is telling us what percent of the shares outstanding the company is buying back each year. So what we can do with ticker data is import the total shares outstanding for the company each of the past few years. And if we look at the changes year over year, we can see what percent of their stock they're constantly buying back. So for Domino's, on average, the buyback yield has been about 3.14% over the past 5 years. That's a pretty solid buyback yield, so maybe we think moving forward it's going to be around 3%. What we can see is the dividend yield plus buyback yield gives us a shareholder yield of 4.83%. So when we add earnings growth and shareholder yield, we come to an expected return of 10.83% annually over the next decade. But then we get to perhaps one of the more important aspects of this valuation, the multiple expansion. What is multiple expansion / multiple contraction? Well, one of the things we have to understand is what the price to earnings ratio for a company is. And we can see for Domino's Pizza, the price to earnings ratio is 24.59. Now, the price to earnings ratio measures how much investors are willing to pay for $1 of a company's earnings. So in the case of Domino's Pizza right now, investors are willing to pay 24.59 times for $1 of earnings. So basically, if we take this share price and divide it by the forward-looking earnings per share, we're going to come to a price to earnings ratio of 24.59. So obviously, as investors, we want to pay less for each dollar of earnings. So on the surface level, you would think we want a lower price to earnings multiple, and that's kind of true, but we also have to take into account how fast are the earnings of the company going to grow in the future? Because sometimes a stock trading at a high price to earnings multiple, maybe stock trading at a 27, 28, or 29 price to earnings multiple, can actually be cheaper than a stock with a price to earnings multiple of just 15 if that higher multiple company is going to grow its earnings at a much faster rate. So when it comes to the price to earnings multiple and Bogle's valuation, what we have to ask ourselves is, over the next decade, how do we expect this price to earnings multiple to change? Do we expect that investors are going to be willing to pay the same price to earnings multiple over the next decade? Are they going to be willing to pay less for Domino's Pizza? Are they going to be willing to pay more for each dollar of earnings for Domino's Pizza? Again, a lot of the times that's going to depend on how fast the future earnings are projected to grow. Other things that could impact this would be things like if the company can maintain a competitive advantage. So let's say over the next decade, investors are going to be willing to pay maybe a price to earnings multiple that's 20% lower than this. So investors are not willing to pay as much for each dollar of earnings for Domino's. We're going to say 20% decline. What would this mean? Well, again, we're looking at Bogle's valuation over a 10-year time period. So we're going to do -2 on multiple expansion because -2 times 10 would be 20%. So now we've inserted each of these metrics for Bogle's valuation, and what we can see is our expected return annually over the next decade in this example for Domino's Pizza would be 8.83%. So this is a fairly simple valuation, but can actually be quite effective when done properly. Now, the last valuation we're going to use is the dividend discount model. So let's go ahead and jump over to the stock valuation sheet and look at an example. I'll come up here and we'll look at Waste Management stock as an example. And again, on the spreadsheet from Ticker Data, there's multiple valuations like Graham's valuation, discounted cash flow, historical multiples valuation, but we're going to focus on the dividend discount model in this scenario. Now, the dividend discount model is fairly straightforward in reality. What we're doing is we're valuing the stock based on how much it's paying out in dividends right now and how much that dividend is projected to grow in the future. So the key here is projecting the dividend growth rate moving forward. So we'd want to look at things like historical dividend growth rates, the payout ratio, the free cash flow growth. Has management stated what their intentions are in growing the dividend in the future? And we can also look at analyst projections, and based off all that information, we can apply a dividend growth rate. So in this example, Waste Management's grown its dividend at about 6.5% over the past 5 to 10 years. So if we go with that rate, discount rate of 8%, we'd come to a dividend discount model price per share of $218.33, which is actually very close to the current share price. So again, this is one that's starting to get a little more complicated, but it's actually still very straightforward. It also gives us a specific buy price. So those are 3 valuation models that are pretty good if you don't know anything about valuation. But again, there are certain valuations that are better than others depending on the type of stock that we're looking at. In a lot of cases, the discounted cash flow analysis will probably be one of the best valuations to use. Historical multiples and multiples valuation can be really effective as well when it's done properly. Again, I have tutorials on all these valuation models and on this entire spreadsheet over on my channel. So we've hit nearly all of these items in this video so far, but the last thing that we absolutely have to touch on is taxes when it comes to dividends, because I see so much misinformation when it comes to taxes, specifically when it comes to actually living off dividend payments. Now, what we typically get told are that dividends are an inefficient investing method from a tax perspective, and before we even get into this, we do have to understand, yes, obviously taxes are going to vary by each individual, based on a multitude of factors. Obviously, where you live, what country, what state, even what city can play a major role, how much income you bring in. But what you have to understand, particularly again, when it comes to living off dividends, dividends are one of the most attractive options from an early retirement perspective and even just a retirement perspective in general. Now, you should already know you can use tax-deferred retirement accounts to not pay taxes on dividends, but that will limit when you're actually able to start using that capital. So let's dive into dividend taxes here for a moment. Now, we're going to talk about a specific scenario when it comes to living off dividends and how you could actually pay $0 in taxes on dividends even when you're living off dividends. In fact, if you're married, you can actually live off $126,700 of dividend income and pay $0 of federal taxes in 2025. And this number gets adjusted every single year for inflation, so it's going to continue to climb higher and higher. So let's talk about what this means and how it works. Let's go ahead and zoom in. Now, the first thing we have to understand is generating $126,700 of federal tax-free money is pretty much the equivalent to generating a salary of $165,000. After you get taxed on a salary of $165K, it's going to come out close to about $126.7K. So in other words, you need to earn about $165,000 from your day job to have the exact same net pay as $126.7K with qualified dividends. Now, the key word here is qualified dividends, but we'll talk about that here in just a moment. So how does this actually work? Well, according to the IRS, if your taxable income is less than $96,700 and you file jointly, you will pay $0 in capital gains tax. And this screenshot is directly from the IRS website. Now, these numbers are based on the taxable income, which means it's after the standard deduction is applied. So for 2025, these are the standard deduction amounts depending on how you file, whether you're married or filing single. But the standard deduction is $30,000 for married individuals, and if you're single, it's about $15,000. So for people that are single, you could generate around $63,350 in dividends and not pay anything in taxes. And if you're married, again, $126.7K. What's really nice about receiving dividends is they aren't subject to taxes like FICA taxes, Social Security, Medicare, unlike your W-2 wages are. Now keep in mind, this only applies to federal taxes, but in many states, as you can see listed out here, you still don't have to pay state taxes. Now, the common question we see is, what if I have other income types? So even if you have other income types, such as wages, required minimum distributions from retirement accounts, or Social Security income and pension, as long as your taxable income is below the threshold, your qualified dividends will still be taxed at 0%. So I already know what you're thinking. What if you're making even more than that in dividend income? Again, this is what's nice. The nice part is that only the amount above the threshold is taxed at the next rate of 15%. So let's look at an example where we generate $150,000 of qualified dividends. Here's how it would look if we are married filing jointly. $150,000 in qualified dividends, we would only pay around $3,495 in taxes. And if we were single, it'd be close to about 13%. So in your single scenario, your effective tax rate would just be 8.6% on $150,000, and if you're married, it's only 2.3%. If you were making a $150,000 salary, you would have paid 24% on the federal tax rate plus FICA taxes on 7% of the $150,000 salary. So as we can see, the tax code can heavily favor dividend investors. Now again, we have to remember this only applies to qualified dividends. So who pays qualified dividends and who pays unqualified dividends, and how do unqualified dividends get taxed? Well, what we have to understand is most of your typical businesses in the S&P 500 are going to pay qualified dividends. So think of most of the stocks we've looked at so far: Domino's Pizza, Microsoft, Coca-Cola. Those are all examples of stocks that pay qualified dividends. But then when it comes to stocks like REITs, maybe business development companies, some covered call ETFs, those would pay unqualified dividends and they get taxed quite differently. They get taxed as ordinary income. So you can see, depending on how you file and how much you generate in income, you're going to get taxed quite a bit more on unqualified dividends. Now again, keep in mind you can use tax-deferred retirement accounts to avoid this altogether. But the point we have to make is with unqualified dividends, you start getting taxed immediately on your very first dollar of dividend income. So keep all this in mind. Obviously, that's going to greatly impact your investment decisions. So we've touched on a massive amount of subjects in this video. And if you were able to stick through it all, then it's my hope you were able to learn quite a bit. But even with all these subjects we talked about, there's still so much more that we can dive into when it comes to dividend investing specifically. So if you want to learn even more, I'd encourage you to go check out dividendology.com, link in the description. And then of course the two main tools that I use in this video are going to be Seeking Alpha, which you can see here, and then we use Ticker Data, which is a spreadsheet integration that allows you to automatically import stock financials straight into your spreadsheet. And you can see I've been able to build many automated spreadsheets in this video. And in fact, all the spreadsheets you saw in this video are available over on tickerdata.com, link in the description. So with all that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.